All right, guys, I'm excited for today's episode. Welcome back to Investor Army Podcast. We have a great guest here today. I met him through a man named Jim Ingersoll at one of the mastermind events up in Richmond, Virginia. He was an ex-TV star on Flip It to Win It. He's a high-end rehabber in California, a broker, a hard money lender, and now he's spreading out across the country, buying cash flow properties, keeping them for rental properties, and keeping the notes using owner financing. Let me introduce you to my guest, Beau Eckstein.
Hi, guys. Thanks for having me, Connor. Should be a fun day.
Yeah, man, I'm glad to have you on here. As always, you're out there doing big things. You've kind of been in the business for a while now. We'll let you introduce yourself here in a second and kind of show how you transition from high-end rehabber to now looking into more cash flow and why you're doing that. But go ahead and tell them who you are and kind of where you're from and kind of your real estate background.
Sure. I've actually been in real estate as far as a mortgage broker and a salesperson since I was about 20. I'm now 39 years old, so it's been a while. I didn't start investing for a long time, but I've learned the transactional components of real estate, which was a good foundation for becoming a real estate investor. But I was really focused on being a mortgage broker in my early 20s, and then got the opportunity to move to Nevada and open their first retail branch there. So I packed up from the Bay Area, California, moved to Nevada, and during that time, I started buying a lot of properties, and didn't really understand real estate investing at that time. I was in my mid-20s and just thought that real estate always went up. And we know what happened in the West Coast in 2007. Anyways, basically lost a lot of houses into foreclosure, and ruined my credit. And then I ended up moving back to the Bay Area, essentially, not knowing what the heck I was going to do, because I thought I was this really smart real estate person. But and so I said, well, I don't have a college degree. I don't know what to do with my time. So I said, I'm going to stick with what I know. And I got back into doing home loans and selling real estate. But the residential lending at that time was very difficult. So it just became a huge pain in the ass. And then I happened to run into a friend of mine who owns a residential mortgage company. And he started telling me that he was a managing member of a fund, and they did private money and construction loans. So I started working with their company. I set up my own company, and I was their origination source, because I've always been a good originator and a marketer. And then I started originating all these construction and renovation loans, and I started watching these investors flipping properties and building spec homes and things. And I said, well, if these guys can do it, I can do it. And then I started flipping properties. Like I said, I was always good at marketing. So from a YouTube video, I got identified for that television show, and I did 12 episodes with them. And that really emphasized the fact that you need to have an online presence, whatever you do. And so I've continued to really blow up my marketing through online means. And so I did the television show, got on the news, publicity. So now today my business is residential lending, hard money lending, and a real estate brokerage. And then, for my passive income goals, I had met a gentleman when I was at a RIA in Las Vegas, because I have a townhouse in Vegas, and I have a mortgage company there. And he was buying properties in Indiana, and he asked me if I'd be interested in funding them from the capacity of being a private money lender. And I'm like, well, my company doesn't lend in Indiana, but I'll look at them personally to fund them, with some of the savings I had. And I looked at the deals, and they looked really, really interesting. I'm like, wait, I can buy properties for $17,000 and put in $35,000, and they're worth $100, and I can rent them out for $1,100 or $1,200 a month. It just made a lot of sense. So that's when I really had a shift in my mindset that, I think the buy, fix, hold strategy is the best to be in. And I didn't want to be under the gun of, having to put in $200,000 or $300,000 in a high-end flip here in the Bay Area and having to borrow all that money. It just got real stressful. And so my model, I have friends here in the Bay Area that do $2 and $3 million projects, and I don't have the stomach for that, nor do I want to have that stress. I always like the the lower end stuff. I mean, I've done a million, $2 million project, but that it was, that's not like my model here. Even in the Bay Area, I kind of like to stick now at least, especially that we're coming to a big peak in our market, is to stick with the entry level stuff because that's still, from everything I've researched, that's the last thing to go in a
Yeah.
peak market and everybody's still buying entry level when the higher end market slows down. So that right now is what I'm seeing in our market. So I'll still do projects around here, but really my shift has been cash flow in the Midwest specifically, and I plan on buying in more cities throughout Indiana, and also looking at
Yeah.
Michigan and maybe Ohio. And I don't want to be too spread out. So when I go get into town in Indiana, I could go and look at all these properties. But that's kind of my platform now. And the nice thing is that right now I have to do my day job, but I get it's I get checks in the mail,
Always
and
good.
everything I do goes together well. Um, but I often wonder if I just focused on one thing, if that
Yep.
would I be more successful? And so that's kind of, I'm just an idea guy, and I don't like the details. I like to find the deal, and then I like to like pass it off. So that's why you got to effectively partner and make sure you have the right team, because you got to know what your strengths are. And
Yeah.
so that's kind of I'm laying out my plan right now. So
Well, I mean, it's tough when you're in your position when you have that many opportunities because when you start out, you're just trying how to find one opportunity or make any type of money, and then you have the ability to go in all these different directions and be successful. As you heard, guys, he's talking about mortgage broking, or he's a mortgage broker. He's a broker, real estate broker. He's got basically real estate run through his blood. And, I was thinking like, remember back with Bo Jackson, like in the '90s or whatever, and it was like Bo knows football, Bo knows this. I'm like, Bo is real estate, right? So he knows pretty much everything about it. He's immersed in the business. Now, you're a good individual to ask this question to, because I get a lot of panic and paranoia right now, a lot of fear mindset. Are we going to have another crash? And since you're experienced with high end rehabs, this is probably one of the riskiest things to be doing, right? Because the heavy carrying costs, and if it sits and you have to drop the price, this is how a lot of people got wiped out. Is this kind of what you faced when you were in 2007? You got a bunch of houses that you couldn't sell and you couldn't make the payments, and they kept the carrying costs kind of ate you alive, or how did that kind of play out?
well, back then I was just speculating. It was far different. I think if you're buying right and you really know what you're doing, like back then we didn't have uh, these um, these avenues to learn, like these podcasts, like your podcast, for example, right? Where you could just plug right in and you could just sit down for days at a time and just figure out, it's basically getting a free education.
Yep.
So, I mean, I didn't realize anything about real estate back then. I just thought, well, I'm going to buy this for this. And I didn't think about cash flow. It's a total different story now. And the difference in the market now is that you have to qualify from an income standpoint. In the olden days, in 2005, we had stated income, and like that was what I got in trouble, because I knew I had a good enough credit score. I could get 100% financing on a non-owner occupied property, and even if it didn't cash flow, it's going to go up 100 grand this year. And that was the mentality.
Yep.
So the West Coast is always like that. Like I think I think it's always true. Like you right now, everybody's talking real estate. Like you can't go anywhere without a pitch to go to some 3-day boot camp and this and that, which I think education is key. But also you're getting so many people in this business that think it's easy, and this business is like probably one of the hardest business. Granted, I have a lot of friends that are younger than me, and they didn't start investing till after the crash, and they got in real estate in 2009 on the West Coast. Anything you bought went up huge, right? So they've only seen this, and so it'll be interesting to see, like when the markets tightens, you gotta really figure out, and that's why I think the buy fix hold model is so good, because people need a place to live. And if I have to reduce my rents down from 1,000 to 800, I'm still going to cash flow.
Yep.
I'm still going to be able to cover my debt on that house. And buying a 20, if I'm buying houses anywhere from $15,000 to $30,000 and then putting a little work into them, to make that payment if there's a vacancy or anything, it's not really a big deal, especially when you got 30 or 40 doors or 50 or 60. So that's kind of my mindset. I do think it's a lot. It's more work, obviously, that you have to buy so many doors. When I look at some of my multifamily investor friends, they go out and they'll buy a 150 unit, and that's going to spit out the same cash flow that my 50 single families are. So there's different models, and I think I'm going to learn something new every day and continue my journey. So one day I'm at the position where I want to be, right? So I think I was just on a mastermind call, and they're like, okay, like you should do a vision board. Okay, what do you want your life to look like? And so I'm doing that, and that's kind of why I did this Excel spreadsheet. Is because like without having a roadmap, you're not gonna track and be able to see what your results are. So far too many years I've spent in my life where I never really documented anything or journaled or didn't any of that stuff. And all the successful people tell you the same thing. So it's like, okay, well, like I know I don't like to do that, but if everybody's telling me to do something and they have more money and more passive income than I do, don't you think you should listen? So that's kind of like, I keep an open mind and I continue to go. Like I was just at Eddie Speed's note school.
Yep.
And I thought it was phenomenal. It gave me another tool in my tool belt, and it's another way to acquire properties. So you can buy like performing and non-performing notes, and then you can, if they don't pay, you can foreclose. And you can do workouts. Owning the paper gives you a lot of different exit strategies as well. So,
yep.
My mindset is just continue to do what I'm doing and learn, hang around people that are doing what I'm doing and 10xing what I'm doing so I can learn and keep going.
Yep. Well, I think what you're doing is smart. I mean, going into these other markets, I've actually looked at doing this as well. I'm looking in Detroit and Jackson and Birmingham. I mean, just because like if we do hit the top of the market, which we will eventually, whether it's a massive crash or some small correction, sometime in the future here soon, we're going to see something like that. And really, when you're buying low price point properties, what's the worst thing that can happen? I mean, people can't, where are they going to move? They have to live somewhere. They're not going to live in a field or in the bushes, right? So you're pretty safe there. So the low end price point properties or wholesaling is going to be your best strategy, in my opinion, if the market starts to correct. You touched on vision boards here. Can you explain a little bit more for people what a vision board is? Because we believe in vision boards here. We actually have vision walls where we have full walls of our office completely, decked out. And I think this is something that new investors get in. They don't kind of look at the other side of the business. They understand lead generation, having to do the day-to-day business, but they don't understand the self-development, the mindset, the thinking side of the business, and kind of going down that process. Can you explain a little bit more what you're talking about there?
Yeah, I think I was the type of guy growing up in my early 20s, and I would always say, well, I'm going to be a millionaire. I'm going to be a millionaire. and right, like, that's great. But if you don't have a plan to be a millionaire or don't have something in front of you every day. So, I think the key things is one is wake up early every day and have a miracle morning. And that's a great book if you haven't read it. But get up early before everybody else is up, and just have your accomplish. I like to be done. Like in an ideal day for me, I like to be done. I like to accomplish by 11 o'clock in the morning. I already worked a full day essentially. Like if you can do that, you're on to something, and then everything else after that's gravy. So waking up early and having a morning ritual, I think is very important. So like for me, it's get up and go to the gym and then, work out. Get up and work out and then, go at it. So, I think identifying your morning ritual is key. And then taking the next step forward is that like on a vision board, you just take a giant piece of paper. Usually it's a big cardboard type paper, and then you put on like your vision. So I'll go on and I'll put my dream house, like the house I want to buy in Las Vegas with the pool and the waterfall and the outdoor landscape, and you put it you'll print it out, you'll paste it onto this paper. So everything you want goal wise in your future, you put it there, and then you just hang your vision board in sight, so you're looking at it every day. So it's like subconsciously imprinting in your mind that this is why I'm working hard. This is why I'm working and always trying to better myself to reach those goals. Because for me, I always thought I wanted to be this super multimillionaire. That's not even the case now. Now I'm like, you know what? My life is pretty simple. If I have, whatever it could be $10,000 for you, 20,000, 30,000 a month passive income. You don't really need much more than that. I mean, my lifestyle, I do a lot of traveling, but it doesn't really cost that much money. So instead of like putting hey, I want to be worth $20 million or $10 million, it's like, no, what do I want on a monthly reoccurring system that every month I go and check my bank account and I got 20 grand a month coming in, and I spend less and less time getting that 20 grand, right? Because if you could do that, I think for me, that's success, because then it enables me more time to do what I like to do. And it's funny because I find that I like learning. For me, it is the big thing. I think that if I don't go and learn something new, on a daily basis, I get kind of depressed. So now I program in my schedule like, hey, I'm going to go to this event. I'm going to spend 3 days masterminding with people and learning about notes or whatever it is. And so for me, if I don't do that, I get burnt out. And so that's kind of how I program things in for me. So just putting it all together. And then, so I did my spreadsheet. So now I know I'm going to buy 43 doors in the next 18 months. And that'll give me about 20 grand a month of income. So I've identified that. Now the next thing I'm doing in the next couple of days is building out the vision board, because I haven't done my vision board. So I'm going to have it all dialed in. And then I think what it is just a roadmap of where you want to be. And then the other thing that's important too is to do like a one sheet, we call it, in one of my mastermind groups. And that just, it's basically a P&L of your life. Like, how you're doing financially, physically, mentally, spiritually, how much you've contributed. And so like we're taught to keep this updated. So then we'll mastermind and we'll bring our one sheets and we'll say, okay, yeah, my passive income right now is at $6,000 a month. I made $500,000 last year, whatever it is. And then this is kind of like your checks and balances to this kind of stuff, right? Yep. And then, so I think I was never like a guy that liked to sit down and do this kind of stuff, but it's so important. I'm finding as I get older that, if you don't really have a clear vision, I mean, I have all the means, I have investors, I have this, I just need to have the plan, the roadmap, and then and then from there, it's like, how am I going to get 2 deals a month? It's very simply, I have my investor carrot website. So I'm going to get, 3 or 4 organic leads. I'm going to start doing a pay-per-click campaign. And I'm going to get 5 leads a month. I'm going to do direct mail. And then you just break it down. Then you kind of track your progression of where you're getting your leads. Like the other day, if you have an investor carrot website, it tells you where the lead source comes from. So the other day, it's like, boom, got a lead, guy wants to sell. It was like, he's like, what's in the questionnaire that Investor Carrot has, it's like, what's your goal or something like that. And the guy says, I want to sell my house for $12,000. Right. So I can call the guy back. I already look it up. You Zillow it. You do whatever due diligence you do normally. And now I have a guy that, hey, this is probably a simple deal. I can go in, fix it up, and I can sell on terms for, $39,000 or $45,000 at 9.9%. So those opportunities are all there. I mean, I get more leads than I can handle now. Yep. And so I'm building the systems to do it. And most of mine's organic, which is great. But going back to that, it tells you where your lead source came from. So then you can track it. So that actually came through one of my YouTube videos. Okay. And Investor Carrot says it on the bottom. So then I go, okay, well, I know YouTube works, right? So continue making YouTube videos and learn how to keyword optimize them and all that good stuff. So that's kind of the way my mind works.
Yeah, I mean, that's all great information. And guys, when you talk about your directions, the reason why vision boards and goal setting and putting it on paper is important, because it brings it to the front of the mind. It's basically right there in front of you. And for example, what really set in about vision boards for me in my own personal business was when I came across this strategy of looking at basically business or your own personal life. I look back at a friend I had when he was young. All around his room, excuse me, all around his room, he had little car models. He had posters on his wall of a LS1 Trans Am or whatever it was, the V8 Trans Am. And then when he was 16 years old, he ended up getting the same car. And I was like, well, that's just basically kind of how a vision board works. You know what you want, you constantly focus on it, and then you track it into your life. So it's very important. Go watch some YouTube videos on what we were just talking about, because I think it'd be interesting for you. Now, I want to ask you something else, because I'm real big about, teaching my students and people that follow us here, the physical vitality and how that applies to their business. So when I was, probably 16 to 23, 24, I was always in real good physical condition. And then, like a lot of people, as I got out of college, I let myself go and got out of shape. And then when I got into business and I wanted to start working long hours, I realized I couldn't do it unless I got myself in shape again. And so I put a lot of effort into basically getting back in the gym and working out, which I know you've been doing a lot lately. Can you kind of tell people how that translates to your business, and how it kind of correlates to running a better business and having more energy and producing more output?
Yeah, and sorry about that. I was getting text. I got a guy at my door. I got one of my borrowers at my door, and I'm like, "Hey, I'm getting interviewed on a podcast."
Go let him in. That's no big deal. We'll wait.
Oh, yeah. Hold on one second.
Good. Go.
All right.
When you gotta do business, you gotta do business, guys.
Oh, really? Yeah. You spilled it. We're doing it online. So here's the paperwork. Okay. Okay. All right.
And he's back.
Okay. Okay. Yeah. So one of my contractors is buying a property, and so he had to get something notarized, and he was.
Yeah. We're business friendly here at Vestor Army. We don't want you to have to wait to get stuff done. Yeah, but I mean, what we're talking about is, I know you've been back in the gym hitting it hard lately, and I don't think enough people understand that you need to work on your mindset, but also your physical condition, especially if you're a hard driving entrepreneur. I mean, you can't put in long hours and stay full of energy and get what you need to be getting done accomplished unless you're in physical condition to do so.
Yeah, I mean, being in good shape is critical. I think for your sanity, especially in real estate, because regardless, it's always a grind. People are always on my retail business, if it's hard money or whatever I'm doing, people always want things done now, right? And it's like, so you're always constantly. Then in real estate sales, or when you're buying a property, right, you're constantly negotiating, and it's draining. It's draining to always have to negotiate. And the way I always look at negotiations is like, I don't need to always beat you, right? Like, even though I know I could beat you, I let people win sometimes, because that's the way business should be done. Like, if you always have to win, I mean, I don't know. It's just, I mean, I know a lot of successful people, that's how they think. But for me, I like that happy medium. Like, I'm a trained mediator, a volunteer. Used to help people resolve their conflicts, which is actually great training. So, like, what you learn is like, through all these negotiations I've had in my life, whether it's me acquiring an investment property, or me negotiating a hard money loan, or me acting as a real estate broker and having to negotiate with the buyer's agent and such. You have to learn how to the recipe for success, because if you don't, I think you're always banging your head against the wall. Because I mean, literally, like, in the beginning of my career, I was always just so stressed out, because it's like people would just like, yeah, you gotta do this, you gotta do this. And I still get worked up once in a while, but I've kind of learned just like, okay, listen, it's going to close. And if it's a day or two late, that's, it is what it is. I've done my job. I've done the best to my abilities. But I think a lot of people need to learn that how to do that. And so going back to the workout thing, yeah, you need avenues to relax, because we could literally spend all day working, learning, and our minds never shut off, right? So I'm a huge advocate of getting good night's sleep. I'm a huge advocate of CBD oil now. That if you want a good night's sleep, I'm a huge advocate of. I take CBD every day now. I think it helps me sleep better. It helps me recover better. Um, and then trying to eat healthy, and then also, getting rid of the bad habits that I have because I'm not perfect.
Yeah.
I pretty much don't drink anymore. Um, the medical marijuana, I do think is good. I'm a, on the West Coast, we're pretty,
He's
we're
from
pretty liberal about,
California.
yeah, yeah. So like even I was in Reno a couple weeks ago, and they have all these cannabis clubs now, and in Nevada they just legalized recreational. So there was literally lines out the door. So
Wow.
now you don't need, like in California, you still need your medical card, but in Nevada, it's like you can just go in if you're 20. I think you got to be 21, and you could just yeah, I'll take that. I'll take that. So which I always I question growing up in when I was younger, I was a I smoked a lot of weed, and then I got kind of out of it because I would smoke weed to get stoned. But I think as you get older, if you learn about like the benefits of CBD oil and things like that, it's huge. So going back to like the whole picture for me is be able to sleep really good at night and work out every day or close to it. You got to give your body some time off, and then just learn some new things and keep closing deals and figure out better ways to um, like figure out the best areas to buy in, because just because you own a thousand properties doesn't mean it's smart. You're better off buying the right properties, because a couple we bought a fourplex, and on paper it looks great, but is it my best investment? I mean, I bought it for 32,000, and I probably put about 12 or 15,000 into it. So I'm in it like less than 50, and the gross rents are $2,200 a month. But the problem with what I find is with that asset class, if you're buying in like a C minus neighborhood, like a fourplex, the turnover is going to kill you. So you're better off buying a single family in a better neighborhood. So like on paper, you look at this and I go, oh, I'm going to get on the 50,000, I'm going to get $2,200 a month. But you might be better off buying that single family and getting 1,100 a month for that same uh, cost, right? Because you're not going to have the same turnover and all that stuff. So I think you know you have to experience these things yourself, because I think if you don't experience this yourself, you're never going to grow and learn. I mean, you can listen to people on podcasts and stuff, and hopefully you can streamline your investing process, and that's what I try to do. But I've made just as many mistakes as anybody, where I go, okay, that fourplex looks like a phenomenal deal. I'm in at 50 and I'm getting 2,200 a month, but the time you take out the vacancy and the turnover, it's not as good as this single family that I've created more equity in, and I get a little bit less cash flow. But once you take out the turnover and the vacancy factor, that single family is a better investment for me. So I think
Yeah.
really honing down, especially when you're buying out of state, is critical.
Yeah. No, that's great information there. So we basically talked about the mindset side of things, the physical side of things. So let's kind of move into actual talking about lead generation, and you talked about your carrot sites, but kind of how would somebody, if they wanted to do what you're doing, and kind of step by step explain to them how you kind of started branching out across the country. First of all, how did you even decide to go into Indiana as your market of choice? I mean, there's so many areas you could go, and because I think that's what stops a lot of people's momentum when they have that thought process. I'm going to go invest in a different market, and then they start, and then they realize there's a lot more to it, right? So, kind of, how can they jump in there and figure out where they need to be going?
Yeah, one is that you're gonna have to invest. You're gonna have to invest time unless you want to buy a turnkey property. But what I found is a lot of the turnkey providers are selling you a house over market value, and you're paying a huge premium to get little cash flow. So if you really want to do this, in my opinion, you have to pick one or two markets. You have to go to the market. You have to build relationships, and that's the reality of it is that unless you're willing to put in the initial work, it's not going to be successful for you. I was just when I was at note school, I was talking to a newer investor there, and he was telling me about the 2 turnkey properties he bought, and I can't remember where he bought them, but in the Midwest somewhere. And it's like, I'm like, oh, what'd you buy it for? What does it rent for? And then he was telling me all the problems he had. And so I think there's, when the market's hot like this, everybody gets the notion, hey, I'm going to go buy out of state and cash flow and become this real estate tycoon, which is the total wrong thing to do, because this guy bought 2 properties that just were bad investments. And he's listening to people, a lot of these RIAs that you go to that are, they're for profit. So they make money when they point you in the direction of buying these turnkey properties.
Yep.
Which is, I run a RIA, I have my own RIA, which I'm going to eventually probably turnkey some of the properties I have. But the reality of it is though, I'm not going to sell people junk. Okay. Because for me, I want to be able to sleep at night. And so I think a lot of these turnkey providers are selling junk to people that want, everybody says, I'm going to be rich doing real estate. But the reality of it is that they're not, and they're going to regret making those purchases. Then they're going to spend the next 3 years trying to get out of the purchase because they can't sell it. So I think if you really want to do it, you need to do it, but you have to, in your spare time, when you're off work, you have to be listening to podcasts. You have to be willing to go travel to these areas, get on sites and start networking. I just went on a Bigger Pockets because I was like, hey, I want to check out a different market in Indiana. So I found somebody in that market. I messaged her, and you know what? She shared so much good information with me. I mean, unbelievable amount of information. So now it's like she gave me her contact for a broker who helped her acquire 20 properties. And that's actually the broker I'm going to go hang my real estate license with, because I know I can learn from her. So I built through that one email I sent. She turned me on a great broker, property managers, insurance agents. And through the broker I just met, who I'm going to go see next week, she turned me on to a bank out in Indiana that does 5.25% 5/1 ARMs, and they'll lend 70% of ARV, where I don't even have that in California. We have hard money at 9 or 10%. So I'm paying my dues by researching all this information. So and that's kind of like what I would tell people. And if you're not quite ready to do this venture where you're buying out of state, maybe you can find an operator like me who's always looking for a partner, right? Like a money partner. And there's a way you could be a lender on the deal, or like our buddy Jim Ingersoll, his model where he's the catalyst and he has the passive investor, and they're both own the property 50-50. So there's a lot of different ways to structure it. And part of my goal is to help other investors. By helping other investors, it's going to help me. So like a newer investor. And so that's why I started my real estate investor club. It's like, one is I love real estate investing. Two is it's a network of people that want to succeed in real estate investing. And I wanted to create a real estate investing club that's not just pitching, different things. I mean, sure, do we pitch stuff once in a while? Yes. I mean, we have different offers, but our investor club is really a networking group to build relationships. And I love when I see deals being done in my investor club. And the thing we're lacking right now is operators in the Midwest or in cash flow markets. So it's kind of my next goal is once I get my systems going, then I can offer some properties to people and JV with them and things. And I think that'll be a good opportunity for everybody, being able to offer that, because the name of the game of this business is having the capital to having the capital in the deal. That's once you have that, I mean, right now, lining up the money and then finding the deals that make sense, and also having enough. What I did in the beginning, I was borrowing money for short term, where now what I'll do is when people want to lend money, I don't want a year loan, because I don't want to have to worry about refinancing them out right away. So I want private money lenders that want to do 5-year loans, because this way I know what I'm getting into and I'm not scrambling to refinance. Because the way those portfolio loans work, let's say I go in and I use a private money lender. In the beginning, I'd use my cash in the beginning, and also private money lenders. But let's say you go in and let's say you go in and I bought one for 22,000, and then I put in 12,000, so I'm in at 34,000. I call up my buddy Adam. I go, Adam, here's the numbers on this deal. The property when it's rehabbed, it's worth 80,000. So I got a huge equity cushion, right? Because I'm only in it 34, and it's going to rent for 1,100 a month. And so he lent me $34,000, but I only did a year loan with him. See, going forward, I want to do the same thing, but I want a 5-year commitment, and I want a lower yield for my investors because they're completely passive, right? So then I completely get out of worrying about refinancing these loans because I could just, as I get my monthly mortgage payment, instead of taking that cash flow right now, just pay down your private investor.
Yeah.
So there's different, yeah.
Yeah, are you doing just interest only loans on those properties, or are you doing kind of like what Jim does where it's it's a 50-50 equity split where they fund it, you provide the property, or are you doing a combination, or what's your best way to finance these low end properties?
Well, like on some of them where I'm creating a lot of equity, like this one I was telling you about. So I'm in at 34, it's worth 80 at minimum. I mean, I've created close to 50 grand or over 50 grand of equity just by buying, right? So if I did the Catalyst program, it wouldn't be as advantageous, right? So I just want to be, on those, I want a debt lender. Now, if the equity position isn't as good, but the cash flow is good, then it could be, we could do the Catalyst program. And Catalyst program means I'm basically the operator and I have a passive investment partner. And then we both go on title, and he or she puts up the $34,000. And then when we get our $1,100 a month rent, we pay our property management and our expenses. Then let's say we're left with $1,000. I'd get 500 and my investor partner gets 500. And then when we sell the property down the road, if we sell it, they get their initial $34,000 back, and then we split the $50,000 equity cushion. So that's kind of like Jim Ingersoll's model, right? That's kind of like what he was doing in the beginning. And I'm sure now he's paying his passive investors less because everything's getting compressed a little bit. So instead of like when I was doing this 2 years ago, I was paying 10% and 2 points, but now I can get a passive investor at 7 or 8%, right? So that's what you got to do. You got to, like, in the beginning, you got to kind of pay the piper. If it pencils out, it pencils out. And as you grow your passive partners or your financial friends, then those numbers need to compress a little bit. And most people are happy getting a 7 or 8% return on something that's pretty secure. So once you prove yourself to be a good operator, I think money's just going to pour hand over fist to you.
Yeah. So like what you just said there, guys, when you're starting out, sometimes all you can get is an equity partner, and it's tough when you're looking at the difference between debt financing and equity financing. Let me break it down here real quick because I'm sure a lot of people don't know what we're talking about. So debt financing, you're borrowing money at interest rate. So whether you own the property for 4 months or 6 months, they're going to get paid per day. Basically, the interest rate, say you have the property for 4 months and sell it, or 6 months and sell it, whether you make money or lose money, they're still going to get paid per day. Now, if they're an equity partner, they actually have skin in the game. And so if you lose $10,000, they're not going to make anything. But what he's saying is that if there's a huge equity spread and the deal's really good, you're giving up way too much, because if the profit's 50 grand, they're taking 25 grand of it when you could have used a debt-based finance or a debt-based lender and probably only paid them, a couple grand. So, and then also if you're using an equity partner and the deal goes bad, you got all that emotional weight of having a partner, you kind of cranking down on you saying, what's going on? Why isn't it going the way it was supposed to go? So you want to get debt-based lending. Are you doing lending around the country for other individuals in certain spots like this, or are you just doing high-end rehabbing loans for your hard money loan business? Or
most of the hard money loans are West Coast, Nevada, California. One of my sources of funds, I can lend in 18 states. So I can definitely lend in certain states, but my core focus is doing bigger loans, 500,000 and above typically. It just makes more sense. What you learn is your time's got certain value for your time. And as you get better and better at your craft, whatever it is, your hourly clock, you get paid a lot more. So for me to do a $100,000 loan and make $1,000, bang my head against the wall trying to help this investor, Not really my business model. I'd rather do loans that are bigger, 500,000 plus, because I typically make a point to a point and a half on the deal, so it's
Yeah.
not a huge spread. So I need to value my time accordingly, and that's kind of the way I look at it.
So with all these little properties that you're buying, is your goal to kind of short-term finance them 5, 10 years and then get them all and kind of go back and do a blanket loan or portfolio loan or like what is your end goal? I mean, because that's a lot of lenders. If you're buying 50, 60, 80 houses to have one lender per property or I don't know if you're mingling them or how you're kind of raising the money to do so, but is that your goal is to put them all on one loan eventually or how do you kind of look at it in the future of
Yeah, I'm gonna have to do some portfolio loans, and then I'll build more relationships with bankers that are local banks. They usually do portfolio lending. So combination of that, and then combination of if you're not using people's IRA money, then you're missing the boat. There's trillions of dollars waiting for you to teach them how to grow, and if you can teach people how to grow their retirement account, they're gonna love you forever.
yeah.
So you gotta be tapping into IRA. So a combination of everything. And the other thing I've been doing lately too is building business credit, and building my credit cards. So like there's a whole recipe for that, but I think that's as you progress, you want to have like I want to have 150,000 of unused credit lying around, right? Because if you're buying properties in the Midwest, you can swipe your credit card on some of them. I've bought in $5,000 houses. I've bought in $6,000
Yeah.
houses. So I want to have all means available for me, and also you can get a line of credit with Home Depot. Make sure you're maximizing your resources, maximizing your private money partners, maximizing everything you can, because really the only time you ever get stressed out is when it's a money bind, right? Like, oh, I got to pay this investor off. I got to go scramble and get 30
Yeah.
grand or whatever it is. Like that's what I got to do today. I got to go wire 30 grand, pay an investor off. So you got to get into the mindset of being able to really, really captivate all this. And most likely you're not gonna be a home run hitter, right? You're not gonna get into real estate investing and make $1 million your first year. I know there's people that have done it, but it's a long-term strategy, and you got to pay your dues.
Yep. No, I totally agree with that. Now, in these small markets like Indiana, are the banks putting loans, a normal finance rental loan on a $50,000 less property? Because here in Texas, it's difficult to get them to want a loan on anything under 100,000. But because those markets, the average property is such a low price point, are the banks doing things like that in those markets? Because I know a lot of people are like, well, I'd want to go in there, but how are they going to finance it?
Yeah. So to answer your question, yes, it's very difficult to get lower end price. Like if you're buying a house for 50 grand or consumer is an end buyer, retail buyer, very difficult because what Dodd-Frank and all that BS have done is created no lender. It costs too much to make those small loans for these lenders, so they stopped doing it, which creates a huge opportunity. That's why you're seeing a huge influx of seller finance deal in the low end market, which is great for us, right? So take advantage of it now. But I just sold the property for 42 grand, which I bought for $5,000. It wasn't that great of a deal actually, just because I should have kept it. But the guy that bought it got an FHA loan. So anyway,
Wow.
there are some, it was a $40,000 FHA loan. So there is funding out there for it, but it's scarce. So I think the seller finance model, as we were talking prior to getting on the video, that I think that's the model to be in to be able to offer that.
Yep.
But that's also another learning curve because there's Dodd-Frank. If you're selling to a retail buyer, you gotta make sure they qualify from an income standpoint. So you got to get a registered mortgage loan officer to underwrite them, and not credit score, but just from an income standpoint. If you're doing more than 3 transactions, they're actually just made a proposal to change that law. So I'm hoping they do. So I think we should be able to finance people how we want to finance people if they want to buy the house.
Now, Bill, let me ask you something. Now, on those low price point properties, when you're buying them for 5, 10, 15 grand, which, some people around the country, especially where you're in California, probably like can't even believe that. But it happens in a lot of different markets. What is your take on, someone who's been successful like you that has a little bit extra cash that you could leave in. Why are you choosing to raise money from a private partner or put debt service on it when you could just self finance it and be free and clear? Let's say you have a 15 grand property and it's renting for 750 after taxes and insurance. You're bringing 600, 7,200 a year. 2 years you're free and clear. Have you gone back and forth and really looked at those models where you just leave your cash in, self finance them, and let them snowball versus actually putting the debt on it, or kind of what is your take on that?
Yeah, well, I think you should always leave 6 months of reserves in your bank, especially if you own a lot of real estate, because there's always rainy days. But yeah, on some of the cheap properties, right? Like if you know how to play the credit card game, you can literally like balance transfer at 0 APR for 12 months, which I just did on a bunch, and you could just go. I just got like $30,000 with for 12 months with zero interest just by this recipe I did. So yeah, you just be creative. But yeah, the cheaper properties, leave your own cash in, forget about the money. It's a forced savings account. So
yeah, what about, are you doing anything like where you got some of these high-end properties? I don't know if you're keeping any that have huge equity. Are you pulling out home equity lines of credit to do any of these little properties? Have you used that strategy yet?
Like most of them, I think is, I self-funded a bunch I have a couple different LLCs, and some of the LLCs have funded these purchases for us. Yeah, I mean, I think that one of my good friends is very good at that. He's a W-2 police officer, makes a good income. And so when he started investing, he invested in California, bought a lot of properties. Now he's in the Midwest in Florida, but he was really good because the way I run my business, like being self-employed, it's way harder to get bank financing, right? Because this company I have might run a loss. The company I have in Nevada, so being self-employed and knowing how to write off things and stuff isn't the best way to get bank financing. So if you can avoid bank financing, which it's the cheapest money there is. So it's like it's a double-edged sword, right? Like you want to pay no taxes, but you want to get bank financing. So you got to kind of find a happy medium of where you're able to qualify for bank loans and stuff. But yeah, I mean, there's just a million ways. And yes, I mean, the cheaper properties, pay with your cash, making sure you always have a reserve. But yeah, if you can like every like maybe one property out of four, you're just using your own funding for, very smart. Then you own that asset free and clear. And then instead of getting $350 a door, you're getting $700 a door, right?
Exactly.
So if you want to expedite and hit your $20,000 a month passive income, it's probably a smarter model. And it also is a forced savings. As a self-employed person, right, we have a tendency, like I'm putting all my money in real estate, right? Which if the real estate market crashes, where's my reserve? So you got to think big picture. So that's what I'm trying to do this time around. The worst feeling is when you got 5 payments due and you got no money in your bank and you're like, okay, how am I going to go pay this $6,000? So I think, going back full circle, investing to me is peace of mind, right? It's not, you don't need to be, this big tycoon if you don't want to be. If you want to be, all the power to you. But, create the passive income, create the plan, and pay your dues, and just keep learning. I mean, shame on anybody out there nowadays if too many people are like blaming everybody for like, hey, I'm stuck in this dead end job. You know what? I've struggled. I've been self-employed for 18 or 19 years or whatever it's been. And yeah, I've struggled. I paid my dues, but you have nobody to blame but yourself if you're not doing it.
Yep.
So get on these podcasts, listen to people, take action, take notes. That's what I do.
Yeah, no, I think that's some really, really good advice. And go back and listen to what I said again, that a lot of young individuals get in this business. They've kind of drunk the Kool-Aid, right? They think that, they have to conquer the world overnight. And what he's basically saying, after being in the business for a long time, hey, it's better to kind of live without the weight of the world on your shoulders, make good money. You don't have to go for the hero money right away and kind of be able to sleep at night. Let's talk about credit cards real quick. This is the last thing we'll go over, and then I'll let you get back. I know you got to do some things today. Now, credit cards are kind of a finicky thing, right? You need them to run your business, and if you use them right, they basically saved my business, but at the same time, they almost caused me to go through bankruptcy. So you have to understand how to play the credit game correctly because it can be very risky.
Yeah.
But if I know a lot of investors who use credit cards to jumpstart their business, but they did so smartly, right? So do you have any tricks working with the banks that you can talk to? Because like if you go back, guys, you should be constantly calling your banks asking for interest rate reductions and credit line increases and to remove late fees. Is there anything that you can give as far as playing the credit game to kind of help some of these new investors? Because they can get into trouble really quickly. Say they have a bunch of cars they're behind on. Which one should they pay down first? The one with the biggest balance or the one with the biggest interest rate, or any tips that you can give that you've learned?
Yeah, obviously, to have great credit, initially you need to have good long credit history. You got to keep your credit card balances at under 35%. But then when you're going, like recently, I just went out and I got 5 new credit cards, and they're in my name. Okay, so there's 2 components. I'm building my personal balances in my credit, right? So I'm getting now. Let's say I have $100,000 in the credit cards or whatever the number is, and so eventually I'm going to convert these personal credit cards into business credit cards so they don't show my credit report. But initially, you need them on your credit report, personal credit report. During the same time, I'm building my entities credit, right? Our businesses have their own credit. And so there's a formula for doing both. And so there's a lot of tips and tricks you can do. But so I got these new credit cards. And then there's a way where you can balance transfer. Typically, you can't get the money. Usually you have to transfer. There's kind of some tips where you can pay them to your company. And then, so I got that money with 0 APR, right? You do have to pay your 3% balance transfer fee. So I got 12 months now. Now I got this $30,000 for 12 months with 0 interest, right?
Yeah.
So then you do what you want to do with it. You recirculate it, pay those down under 35% within the next 6 months. And now I was at 720 credit score. Now I'm going to go to 800, right? And then once you're 800, you call them back. Let me raise the credit limit. So my $20,000 or my $10,000 card is now 20.
Yeah.
So then I just doubled my credit. So let's say I have 100,000 credit cards. Now I can maybe get 200, or maybe I have 50,000. I can get 100,000. During that same time, you're building your business credit. And then there's a formula for moving those personal credit cards into your business name, and they'll transfer it. Then because you don't want to have too many open credit lines on your personal credit report, right? Even if there's 0 balance, it's going to affect you. So you want to have that ratio. So I think for me now, it's all about security. I want to know I have 100 grand in credit if I need it. I want to know I have 6 months of reserve in cash. And this way, when all of a sudden there's something that was uncalled for, let's face it, you're going to buy these properties, a lot of them sight unseen if you're buying out of state, and you're relying on a lot of people. So, I bought one house and I was told it didn't need a new roof. And then of course I looked at it one time and I could see it needed a roof, right? So you just gotta, and that's learning for me. That's like, hey, I'm going to get an inspection on every property because, if I'm not there, I'm sorry, I'm not going to trust anybody's opinion really.
Yeah.
So little tips like that, but having the reserves and then being able to take that 30 grand I just got and buy a property and turn it, and then maybe sell or finance it, or maybe I'll sell a front portion of my note on that seller finance deal, and I'll get my $30,000 back, and then I keep the tail end of that note, and I have in 5 years I get all the payments for the next 5 years or whatever it is. So there's so many structures.
Yeah, I mean, I think it's a lot smarter approach which you're taking right now, because I like talking to people like Beau who've kind of been through the crash, have some seasoning in their business, understand the whole process, because I see a lot of people right now, these fly-by-night companies, they're getting bailed out. They're making 20 grand a house, but if they were in a flat market or a diving market, they'd be losing money. And so he's talking about making sure you're smart, have a safety reserve to fall back on, because he went through the last crash, and I think a lot of people are going to get wiped out again, and they're buying these houses that they're getting bailed out because they're not good at what they do. It takes them 4 to 6 months to fix up the house, and by the time they're done, they're selling it for 25 grand more, but that's all their profit. And he gave you some good tips there with the credit cards, guys. Just be smart with that. So how often do you think that you should ask for a credit increase when you go back to them every 6 months or every 3 months, or because you can quickly jump your credit lines up, especially after you run a balance up. What I've noticed when we run one up, so we'll buy a rehab property, we'll run it up, we'll pay it off, and I ask for a credit increase pretty quickly after I pay off that full balance, and usually they give me anywhere from a 5 to 10K increase. Do you see that?
Yeah. I think that's smart. I think they have an algorithm of figuring out when you can, but I think by charging up over 50% of the balance, even some of them I'm charging 85% on balance transfers, and then paying it back in a fairly quick manner. That's what really is good. So I think 4 to 6 months for your first initial ask. And a lot of people that are listening and probably are, most people don't have lots of money sitting in their bank right now. You're either starting out, or you're like a corporate guy that's quit your job and now you got, 200 grand in your account and that's all you got to your name. No matter what, I always tell people, if you can leverage, but leverage in a good way, and make sure you're not leveraging in a bad way. Like, don't leverage because you want to buy that new $70,000 car. Okay. Go buy 3 houses.
Yeah. All right. Well, Beau, I know you got to go right now. Let people know how they can get a hold of you. Obviously, you want to partner with them. If y'all are in some low price point markets, send your deals to Beau. He's looking to buy. Also, I'm sure he'll help you out if you're looking to do things in California with hard money loans. Go ahead and tell him how to reach you. Give him your website and your phone number. We'll put it below here on the iTunes as well on YouTube, so you can go ahead and find him that way.
You could just go to, I have so many websites. You can go to getloanquote.com. You can call me, or actually you can text me. I'd rather get text, 925-852-8261. That's 925-852-8261.
So guys, are there any other markets you're really targeting in right now, so you can kind of give the shout out to, you're just mainly in Indiana, or any markets you're looking at?
I'd like to purchase in Indiana, Michigan, and Ohio, I think would be targets, and then parts of Florida. But for now, I'd like to be able to fly into like Chicago and be able to go to Indiana and maybe 1 or 2. So I want something in a 300-mile radius of that area of Indiana, northeastern Indiana.
Are you looking to buy turnkey properties, or are you looking to buy them and kind of stabilize them on your own, or
stabilize them on my own for sure? Yeah.
Okay.
I mean, that's where you make your money. You don't make money buying turnkey.
Yeah.
Unless you're buying without all the cushion in it. So.
Okay. The last question before I let you go. So if you are doing that on your own, and how are you, because like you just said, you want to make sure you look at your properties before you buy them. So you're buying a property halfway across the country. How are you flying out before you take title to any of these to really look at them, or do you have an agent or your property management company run by? How are you? I mean, obviously, if the house is $5,000 and the numbers work, how bad can you get hurt? But at the same time, right, you want to keep these properties. You want to make sure you don't have one that's structurally compromised or major issues.
Yeah. So, got to build your boots on the ground, get on bigger pockets, get on some forums, start messaging people in the area. Plan on going out there. Like, what I'm going to do in Indiana is I'm going to buy a house there and put a 4x4 in the garage. Go out there every month. I mean, if I know this plan right here can get me out of the rat race, even though I'm self-employed, I still consider myself in the rat race, right? I'm the only boss I have myself. If I know in 18 months I can get enough money to just say I don't need to talk to anybody and do a hard money loan again, although I probably will. And it requires me flying out there once a month. Big deal. Just do it. But you can also do the same thing and buy properties by finding good boots on the ground.
Yep. All right, man. It was good to have you on here. Grateful that you came on here today. It's always good to talk to you. And guys, reach out to Beau if you think you can work together, or if you have some properties they potentially want to buy from you, if you're wholesalers out there in Indiana. Yeah, I mean, unless you have any final words of advice that you want to give our audience, we're going to wrap it up.
I got tons, but probably that'd be another call.
Starting out hour number 2 now. No, I'm just kidding. All right, man. I appreciate you coming on. And guys, we'll see you on the next episode of the Investor Army Podcast.
Bye, guys. Thanks.